there's anything to take away from what I'm about to say, it's probably this, that it might not be a bad time to be looking at equities. Now, it's a strange thing to say, given that we've seen markets retreating substantially, particularly over the past quarter, but we think we understand why that's happened. Now, the background to all of this is that central banks have been raising interest rates, and they've been doing this into economies that are seemingly slowing down. And the issue is that they're worried about inflation. They're worried that inflation is a greater threat than seeing a little bit of recession. And in fact, what's then happened is that investors have looked at that, seen higher interest rates and seen higher energy prices and seen tight labor markets, expensive labor markets, and just thought that margin compression was coming, and with that, erosion of corporate profits. We think that that might be an overly pessimistic view. We think that corporate profits might slow down, but that they might not necessarily contract. And that is the key to our view. If we look around, we've seen that multiples have come off substantially. So in the local market from about 19 to 11, we've seen it in the US from about 30 to about 20 or so. We've seen it in the UK 25 to 14. So the markets have already prejudged. And the question is, what happens to earnings going forward? If we look at where total returns tend to come from, they come from earnings growth, from the dividends that are paid from that earnings growth, and then from multiple expansion or contraction, which really is how much would investors be prepared to pay for earnings. And we've seen that part already being worked down. We do not think that earnings will materially come off from here. We think that if you want to look at specific places to invest, you want to probably stay exposed to materials and energy stocks. We think that you might want to look at some tech shares that may offer some value, given the amount of price reduction that's come through there. But we would still caution on select areas such as property, which are relying on bank funding, which we expect to be conservative, to fund the deal making. If you want to look geographically, we think that the US, which has driven global equity returns for the last decade, to be a place you want to start moving gradually from and more into other DMs and maybe into other EMs. We think in EM space, South Africa screens particularly well relative to its own history and relative to other EMs. And when we think about our fixed interest components, there we see opportunity to hold, these super yields we've got in the portfolio. We think there's an opportunity to add gradually to them. We see markets anxious about the short end where, SARB hiking impacts the greatest. When we think about our fixed interest component, we think that there may be some opportunities in this caution. We have seen some anxiety coming through into the bond markets as well. They've benefited linkers, but in nominal space, we still think that there might be a good opportunity because we see a risk premium being priced higher than we think they ought to be. And therefore, some of the cash that we have may well be deployed to picking up some bonds in addition to the equities that we've already spoken about.